TSMC just told us where $56 billion is going this year alone. Not toward the chip you already know about, toward the infrastructure that makes that chip possible. And it flows to a group of companies in Japan, Taiwan, and Israel that almost nobody on this side of the market is paying attention to. I went through the earnings transcript, and I almost missed the most important part. I was halfway through the CFO's section when I nearly scrolled past a line about a risk that has nothing to do with Taiwan, nothing to do with AI demand at all. But first, where the money actually goes. TSMC builds chips. They don't design them. Apple designs the chip. NVIDIA designs the chip. When those companies announce a new chip, TSMC is the factory that actually manufactures it. They're the most important fab in the world, and AI has put them at the center of the most critical supply chain on the planet right now. Last quarter, $35.9 billion in revenue. Net profit up 58% year over year. A fresh record. Beat on estimates. But here's the part that stopped me cold in the transcript. CEO C.C. Wei said this, and I'm quoting him directly: the shift from generative AI and the query mode to agentic AI and command and action mode is leading to another step up in the amount of tokens being consumed. Most coverage glossed right over that line. Here's why it changes everything. Query mode is what most of us use today. You type something into ChatGPT, you get an answer back. One input, one output, one compute event. Agentic mode is completely different. The AI doesn't just answer, it acts. It plans, executes steps, calls tools, loops back, corrects itself. A single task might involve hundreds of compute steps instead of one. More steps, more compute. More demand, compounding. This isn't a linear demand story. The curve bends upward the more capable AI gets. And every time capability increases, the demand for hardware that runs it increases faster. Wei put a number on it. TSMC now expects AI accelerator revenue to grow at a 54 to 56% compound annual growth rate between 2024 and 2029. Their previous estimate was 45%. That's not a small revision. That's management raising their own conviction on how fast this moves, while the chips are already selling out. Pair that with what CFO Wendell Huang said on the same call. TSMC's total capital spend and his forward guidance for the next 3 years, significantly higher. TSMC guided Q2 revenue at $39 to $40.2 billion against analyst estimates of $38.1 billion. Full year guidance raised to 30% plus growth. Management is guiding above consensus while simultaneously raising CapEx. That doesn't happen when you're worried about demand slowing down. That's a signal this is durable, not cyclical. Here's what most coverage got completely wrong. TSMC isn't spending $56 billion on chips. They're spending it on everything that makes advanced chips possible. The packaging infrastructure, the inspection equipment, the substrates with thermal systems. The chip is the headline. The supply chain is where the money actually lands. When you build a skyscraper, the steel beams get all the photos. But the real spend is in the foundation, the HVAC, the electrical systems, the elevators. Without all of that, the steel beams don't work. Same principle here. TSMC actually disclosed the breakdown. About 70 to 80% of their CapEx goes to advanced process technologies, but 10 to 20% goes specifically to advanced packaging, testing, mask production, and supporting infrastructure. On a $56 billion budget, that's somewhere between $5.6 and $11.2 billion flowing directly into the segments I'm about to walk you through. Everyone already owns the infrastructure that makes it run. 4 segments in order of how directly each ties back to TSMC's spending. Segment 1, IC substrates. A substrate is the base layer a chip sits on. It routes electrical signals between the chip and the rest of the system. As chips get denser, the substrate has to carry more connections in less space. It's an engineering problem that gets harder every year, not easier. The companies making these substrates at the leading edge are capacity constrained. Ibiden in Micron and Nanya PCB in Taiwan, not household names, but they sit at the exact bottleneck TSMC's CapEx is trying to solve. Substrate availability has been a genuine choke point as AI packaging density has increased. And a capital commitment of this scale from TSMC is exactly the kind of signal that justifies the capacity expansion decisions these companies have been debating. What I want: substrate average selling prices, yield rates, and customer qualification progress. Those are the signals that tell me whether the thesis is actually moving. The next segment has something Substrates don't. A direct quote from TSMC's CEO confirming the bottleneck by name. Segment 2, Advanced Packaging Inspection and Test. CC Wei said on the call, our advanced packaging capacity is very tight also. That's the CEO confirming the bottleneck, not an analyst guessing. When you're stacking dozens of chiplets inside a single package, which is how the most advanced AI chips are built right now, every layer of that assembly has to be verified. If something fails and you don't catch it, you've just destroyed a $30,000 chip. At the scale these companies operate, bad yield rates are catastrophic. That's what inspection and test companies do. They catch failures before they ship. Camtek in Israel, MATech and IST in Taiwan. As packaging gets denser and more failure sensitive, their tools become more critical, not less. And remember that $5.6 to $11.2 billion slice of TSMC's CapEx specifically earmarked for advanced packaging and testing infrastructure? That capital has to land somewhere. What I track here, order intake, utilization rates, how fast advanced packaging is growing as a share of their revenue mix. The previous two segments are about making and verifying chips. The next one is about something different. Who designs the chip in the first place? And that opportunity is structural in a way that doesn't depend on any single company winning. Segment 3, ASIC design services. An ASIC is a chip designed to do one specific thing extremely well, not a general purpose processor that handles everything adequately. A custom chip built for a specific workload. When Amazon, Google, or Microsoft wants a chip optimized exactly for their AI workload, they don't build an entire chip design team overnight. They hire a firm that specializes in it. Those firms sit between the hyperscalers engineering team and TSMC's fab. They handle the design, the engineering, the verification, the coordination. GUC in Taiwan, Socionext in Japan. The opportunity here is structural. As more companies decide they want custom silicon instead of off-the-shelf hardware, and that trend is clearly accelerating, the design services market grows with it. It doesn't matter which hyperscaler wins. They all need someone to design the chip. Segment 4, Thermal and Power Infrastructure. Delta Electronics, Luxnet, or Shunsit. These companies benefit from AI infrastructure build-out broadly, but the connection to TSMC's CapEx specifically is more indirect than the first three segments. Don't group them with substrates or inspection in your thinking. Why non-US listed names instead of the US companies in the space? There are US equivalents. Teradyne and Onto Innovation for inspection, Broadcom and Marvell for custom silicon, Vertiv and nVent for thermal. Real businesses, real exposure to this theme. But they also come with US valuations and full analyst coverage. The market has largely priced in what's visible. The non-US names I'm watching operate in the same supply chain with less overlap to the US mega-cap chipset, and in some cases have historically traded at a gap relative to their growth profiles and capacity expansion plans. I say historically deliberately, so let's pause for a moment. The AI trade is no longer a secret. Some of these non-US names have already run hard as the theme has spread beyond US markets. A compelling fundamental thesis and a compelling entry point are two different things. Before you look at any of these names, check where valuations actually sit today relative to their own history. Don't assume the gap still exists just because it did 6 months ago. The risks are real, and I want to name them. Every company I talked about today is listed on a non-US exchange. Taiwan, Japan, Israel. That means currency exposure, different reporting standards, liquidity differences. For Taiwan-linked names specifically, there's geopolitical risk that isn't theoretical, and you have to account for that. Time zone gaps also mean overnight moves can be wider and harder to respond to in real time. Remember that line I mentioned at the top? The one I almost scrolled past? Here it is, the Strait of Hormuz. Most people think about that waterway in the context of oil, but it's also a critical shipping lane for helium and specialty chemicals used in chipmaking. The ongoing conflict in the region has severely limited maritime traffic through it. CFO Wendell Huang specifically warned that disruptions to specialty chemical supplies could hurt TSMC's profitability over the long term. He said there's no near-term impact expected, but he flagged it on the call, publicly. That's not nothing. What this means practically, the supply chain risk in this thesis isn't just about Taiwan. It runs through the Middle East too. A sustained disruption to those chemical supplies affects the entire fab ecosystem, TSMC, and every supplier downstream from it. One risk gets underestimated right now: valuation. Some of these names have already repriced significantly as the AI infrastructure theme has gone global. The fundamental story can be completely intact. Substrates really are a bottleneck. Packaging inspection really is critical, and you can still overpay. Paying too much for a good business is its own kind of risk. The thesis being right doesn't protect you from buying it at the wrong price. Non-US investing isn't harder in principle. It's just different, and you need to go in with both eyes open. TSMC's earnings weren't just a revenue beat. They were a capital signal. $56 billion this year alone. Forward guidance of significantly higher. A CAGR estimate on AI accelerators just raised from 45% to 54 to 56%. And Q2 guidance that came in above analyst estimates while CapEx went up at the same time. That money doesn't stay at TSMC. It flows outward to the entire infrastructure that makes advanced chip manufacturing possible. And buried in that supply chain, in Japan, Taiwan, Israel, are companies most US investors have never looked at. The investors who got to work optional weren't the ones chasing the headline trade everyone already knew about. They were the ones who understood the layer underneath it, before the crowd got there. That's the lens worth building. The market isn't wrong about AI. It's just looking at the most obvious part of the picture. The supply chain underneath it, that's where the next chapter of this story gets written. My newsletter isn't a stock breakdown. It's how I use first principles to spot the structural shifts moving markets and the companies positioned to benefit. If that's the lens you want, links in the description. Drop a comment with supply chain names you're watching. And if you want to see how I apply the same supply chain thinking to another sector entirely, that video is next.